Hello and welcome back to CAIIB Guru. In today's session, we'll be talking about credit rating, approach to it, a key concept under the credit risk models in your CAIIB bank financial management. Let's get started. Let's begin with a basic question: why do we need a credit rating approach in banks? To manage credit risk effectively and proactively, banks need two things. 0. A well-designed credit rating model to assess borrowers before lending. 0. A system to track default data category-wise to understand how reliable those ratings were over time. Together, these form the foundation for sound credit decision-making. So, what exactly is a credit rating model? It is a structured way to differentiate borrowers based on the stability of their revenue and profits. In simple terms, it tries to answer, can this borrower generate consistent cash flows to meet their obligations? For instance, if a business shows consistent sales and profits year after year, its risk of default is lower. Hence, it gets a better credit rating. On the other hand, a business that sees ups and downs in its income is riskier even if its profits are high. Now this is important: does a company making more profit always get a better credit rating? The answer is no. Credit rating is not just about profitability, it's about how stable that profit is. Let's take a simple example. Government securities give low returns, but the income is fully reliable. So, they are rated highest, often AAA or A++. In contrast, a private company may earn more profit, but if its revenue fluctuates heavily, it will be rated lower due to higher uncertainty. So, we evaluate not how much profit is earned, but how reliably it is earned. Now let's move to what factors are used in designing a good rating model. A strong rating model considers the past 3 to 5 years of financial performance, the business environment and industry risk, the borrower's business model, management quality and governance. But there's also a balance to maintain. The model must be simple enough to use practically, but also robust enough to capture risk accurately. If it's too simple, it might miss important signals. If it's too complex, it becomes impractical for users. To understand this better, let's look at an analogy from academics. Imagine a college that reduces its exam difficulty just to show more students in first division. What happens? The overall standard of the college drops in the eyes of employers and the public. Even genuinely good students suffer because their achievements are undervalued. The same principle applies to banks. If a bank uses an easy rating model and gives most borrowers high ratings, the market will eventually realize those ratings aren't reliable. That's why it's important to maintain rating standards, even if it means fewer top-rated borrowers. So, where do we go from here? To truly validate whether your credit rating model is working, you need to track how your rated borrowers perform over time, especially whether they default or maintain their commitments. This is where the concept of rating migration comes in. But we'll discuss that in the next session in more detail.